Assalamualaikum warahmatullahi wabarakatuh. Welcome back to Sada Education. As I have mentioned several times that Sada Education serve to promote or serve to highlight the importance of consumer financial protection. So Bank Negara, in 2019 has issued the policy document on fair treatment of financial consumer. This policy document aims to foster high standards of responsible and professional conduct in a financial service provider, which is the bank, and promote a culture where the interests of the financial consumer are an integral part of the financial service provider's business strategies and operations. Set expectation for a financial service provider to effectively manage conduct risk and provide financial consumers with the confidence that the bank act fairly in its dealing with financial consumer. So that is why I have been for the past few videos I have been explaining to you about the concept of sale and riba, and as well as looking at the pricing of the financial product, because as you see in the PDS, the product disclosure sheet, for example, from Bank Islam on property financing, there are quite a number of items here that need further explanation. For example, the ceiling profit rate of 11% per annum. And then we have the effective profit rate of 3.15% per annum, which is lower than the ceiling rate. Then we have the bank sale price, right? And therefore these terms require explanation from the bank, and I presume that the banking staff or the banking officer should be able to explain to the consumer or to the prospective customer what this rate means, and therefore the journey to educate the consumer can begin based on the PDS issued by the Islamic banking company as required by the regulator. So I will continue from the previous program regarding the finance charge or the interest rate or profit rate set by the bank. And as you see from the PDS over here, this profit rate or interest rate are called effective profit rate. And therefore my role here is to further elaborate on the component of this profit rate, so that consumer can understand better what are they getting from the bank. As I have said in the previous program, that the interest rate consists of various components. Number one is the cost of deposit. This is the amount of the interest rate that the bank pays the depositor, and the bank also pay for the overhead expenditure. But the main profit earning component would be the spread, which is the interest rate that the bank charges on the riskiness of the loan, right? So additional interest rate as a charge on credit risk. So bank would usually make money from this component of the interest rate. As I said, most banking profit are obtained from the spread. So the strategy usually is to offer subprime loans or low quality loans, so that the bank can earn more profit by charging high interest rate. But this can expose the bank to big losses when many of these loans can get into defaults. So the strategy of trying to maximize profit by virtue of charging higher interest rate in return for giving out loan without collateral or clean loan. This is a highly dangerous strategy that many banks have pursued, and this is what we would like the central bank to come in to control and to remedy, so that this aggressive behavior can be eliminated in order to ensure that the bank remains stable. So, for example, over here, loan rate is determined by the credit standing of customer, right? So if the loan is offered at $100,000 and the cost of fund is 3% and the overhead cost is 1% and the spread is 3%, so for a 5-year facility, the interest income will be 35,000, where the total debt obligation of the borrowing party will be 100,000 plus 35,000. That will give us 135,000, and we divide that by 60 months, which will give us a monthly installment of 2,250. But if you look at a case of a customer with a high credit standing, we have the same facility, but now due to the high credit standing, the spread has been increased, from 3% to 6%, and therefore the interest margin is 50,000, and total debt obligation now has risen from 135,000 to 150,000. And when we divide that by 60 months, the monthly loan payment is 2,500, which is higher than the previous example where the spread is at 3%. So this is the implication, even though we are taking the same amount of facility and for the same year, but then a low credit worthy customer will have to pay more than a high credit worthy customer. So this is how the bank is conducting their pricing strategy. And if the bank is aggressive enough to go for a much more risky strategy by taking more and more low credit worthy customers so that they can charge higher interest rate. So this is the business decision taken by the bank, which warrant them to be very careful to mitigate any danger that may come due to the high amount of low quality loan issued by this bank. So that is it. So this is what we have for today. I'll see you again in the next program. Thank you very much. Don't forget to comment and share and subscribe. Bye bye. Thank you.